Coming up, Treasury yields breaking out to new highs. The Federal Reserve gearing up for big moves in May. Looking ahead to inflation with an 8 handle. We begin with the big issue, hoping for a soft landing.
The ever elusive soft landing.
It's going to, I think, require some fancy footwork from the Fed.
Growth is slowing and financial conditions are tightening.
It's going to be very difficult for the Fed to focus on just inflation.
This is tricky.
The big question is, does it morph into a recession?
The Fed's path to this soft landing has narrowed.
It is this tight wire that they're going to have to be walking.
The goal for the Fed is to bring about a gradual tightening in financial conditions.
They need to normalize. They need to normalize as quickly as possible.
It has to be some combination of weaker stock prices, higher interest rates, a stronger currency, and wider credit spreads.
There's a risk that the Fed over-tightens. There's a risk that the Fed under-tightens.
It seems unlikely that we're going to be able to avoid a harder landing.
Let's have that conversation right now with Goldman's Amanda Lynam, TCW's Laird, Landmann, and Bank of America's Mark Cabana. Let's start with you, Amanda. Can the Fed engineer a soft landing? How elusive is that, and what does it mean to you?
Sure. Thanks for having me, Jonathan. So we heard Jan on your program this morning saying that it will require some fancy footwork, but the base case is not for a recession. Our economists see about a 30% chance of recession, but they don't view it as inevitable. And so that's something that we're watching very closely. I think the credit markets are telling us a similar story. We've had some pretty meaningful tightening from the local peaks of mid-March, and I think investors are looking around at fundamentals and bracing for a slowdown in growth. But it does not seem as though the credit market is incorporating a recessionary fear at this stage either.
Laird, how binary is the situation right now? There are people who believe it's either or. Either you prolong inflation or you risk recession. Is it a situation of either or?
I mean, I don't think so.
I think that's exactly what the situation is.
Carry on, Laird, please.
Oh, sorry. I think that's exactly the situation. I think that, we've had over 20% M2 growth over the last couple of years. There's been huge accommodation on the part of the Fed. When you get runaway inflation, when you have monetary accommodation combined with some of these supply shocks we've seen, I think obviously some of the supply shocks will clean up by destroying demand, some of the inflation, but the Federal Reserve is going to have to throw some people out of work. I very much agree with the economists who are saying that you're not really going to get relief from the wage price spiral until you see the unemployment rate begin to loosen up here a little bit. So it's a very tough choice for the Fed.
That's exactly what Bill Dudley thinks as well. I'll quote him directly from a piece he wrote a little bit earlier this week on Bloomberg Opinion, when he said one thing is certain: to be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Mark Cabana, I want to come to you, sir, and we'll get to the balance sheet issues in a moment. Do you agree with this line from Bill Dudley, the former New York Fed president, that to be clear, to be certain, in his words, to be effective, it'll have to inflict more losses on stock and bond investors than it has so far?
Yes, we do agree with that, especially on the fixed income side. We do think that in particular, real interest rates still have to rise further. Real interest rates right now are still quite accommodative. 10-year real rates have moved a lot this week. We think that there's further upside there. And we also think that the Fed probably needs to take real rates at the front end of the curve into a place where they're finally restrictive. The Fed is a long ways away from that today, and they really do need inflation to come down and for those rate hikes to kick in order to get that real tightening of conditions. So yes, we do think that there are headwinds to risk assets. And we also think that real interest rates probably need to rise further in order to bring this about.
Mark, the thing that I hear quite a lot of is that we're seeing the peak in Fed hawkishness. And then I'll ask people, OK, well, can you tell me what QT means to the market? And they'll tell you, no, I don't really know what that means to the market. So how can you say that we have seen peak Fed hawkishness if no one really has any conviction on what QT means, Mark?
I think that's right. I don't have a lot of conviction that we have seen peak Fed hawkishness, especially because we know that the Fed tends to overshoot in these types of environments. They tend to miss some of the early signs of a slowdown, keep tightening, both through higher front-end interest rates as well as through QT. And the Fed will tell you that they don't have a lot of confidence in exactly how QT impacts the real economy. We've heard estimates from Powell and others on the Fed that QT might be worth one 25 basis point rate rise, maybe 50 basis points of rate rise, but they don't really know. And so this is the Fed that's very much, like Powell said back in 18, like it's walking in a dark room, feeling its way around as it approaches neutral, knowing that rate hikes are impacting the front end, QT is impacting liquidity in the system, likely the back end, and likely financial conditions, but they don't know exactly how to calibrate those two. And therefore, the risk of an overshoot, in our view, is quite meaningfully high.
So we've got QT, Amanda. And Amanda, you've also said that corporate credit quality has peaked. You've come on this programme in the last few weeks and said that. Throw in everything that Mark Cabana is speaking about. You're underweight in credit, and throw in this too, cash. Can you talk to me about how cash competes with credit in your mind at the moment?
Absolutely. So from a relative value perspective, we believe that as rates continue to rise, specifically in the front end, cash is coming back as an investable asset class option. And so it really does reduce the value proposition of things like short-dated IG corporate bonds, high-quality front-end paper. So you do have to be careful in terms of an erosion of the value proposition going forward. As you mentioned, our kind of global portfolio strategy allocation has an underweight to credit. Within credit, we're still having a slight overweight on high yield versus IG in the US market. In Europe, we're a little bit more defensive, overweight IG versus high yield, and then still expect that kind of curve flattening bias. So underperformance at the very front end and then outperformance at the very long end.
Laird, you're underweight cyclicals. Laird, you're underweight industrials. You believe the Fed could do some damage here to the labour market as well. That might well be the objective of this Federal Reserve, one they won't talk about, of course. Can you talk to me about what you're overweight?
Sure. I mean, I think when we feel the same way about credit. It was worth buying a couple weeks ago when spreads got out to 130. You were able to buy new issues in the 140 to 150 area. It's tightened in since then. We don't really understand why. We've been selling. We think agency mortgages, your Fannie Mae's, your Ginnie Mae's have gotten to the point where it's worth dipping a toe in. Prices are low. The negative convexity on mortgages is at an all-time low. And spreads are pretty wide. And I think they're obviously front-running the news of portfolio sales. And I would say as it relates to QT, the Fed broke things in 2018 doing QT. They'll probably break different things this time. They always, in these tightening cycles, they blow things up along the way. They're probably meant to be blown up, but there will be lots of volatility. And I think for opportunistic investors, I don't want to sound too ghoulish, but I think there'll be a lot of these trips higher in spreads in different asset classes that you'll be able to take advantage of.
Laird, can you take me back to 2018 and tell me what you mean by they'll break different things this time? What they broke last time, I remember the primary market completely shut down. We all remember what happened with high yield spreads that December in 2018. When you say things broke then and you think something different will break this time, what do you mean by that?
Well, I think that the funding market, they've put mechanisms in place where it probably won't be the funding market that breaks during QT this time. It may be any other market that, we could not predict in advance. But I think that this is an experiment, the whole quantitative tightening, quantitative easing experiment. We're still in early days on this, and this is the second attempt at it. And my guess is that when we pull this liquidity back, we're going to find areas of the markets and mechanisms of the market where the tide goes out and people are not wearing their bathing suits, as the old expression goes.
We've heard that a few times. Mark Cabana, I want to bring you in just on the amount of QT you expect, the caps that we got from the Fed minutes this week, and how that influences your thoughts on what you expect now versus what you expected before.
Yeah, we were actually a little disappointed in terms of what the Fed announced on QT. We thought that they would, in particular, treat their bill portfolio a bit differently and allow for a faster overall runoff. So after the minutes this week, we actually ratcheted down our expectations on how much balance sheet shrinkage we would get this year from around $930 billion to about $650 billion. And again, the delta there is really due to the treatment of the bill portfolio. But look, there's going to be a more aggressive approach to QT in 2023 and 2024 than we had previously thought. So the Fed's just going to be a little bit more gradual in moving into this. But There's a lot of liquidity that's coming out. Even in this year alone, given our expectations of now about a 650 billion liquidity drain, that's almost equivalent to what they did in the last episode of QT. So these are very, very sizable numbers. And just in 7 months this year, you're likely to replicate what you had over the course of about a year and a half in the last episode.
It's all happening much, much faster. To the three of you, can I say thank you? We, of course, had to interrupt this program for an important historical moment for history in this country. So thank you very much for the patience of Amanda Lynam, Mark Cabana and Laird Landmann from New York City. That does it for us. Bloomberg Real Yield. We'll be back next week. This is Bloomberg.